Hello, my name is Victor, and I want to start off today by congratulating everyone who had the mental fortitude to hang in there through the first quarter of 2026. And particular kudos are in order if you were actually taking advantage of the opportunities, buying at those cheaper prices throughout 2026, because it seems like we are well on our way towards a V-shaped recovery, at least here in the middle of April. Now, I made sure to catalog every single stock that I was focusing on for the past 5 to 6 weeks. So if you're interested, be sure to check out the YouTube channel later after this video, because I know I was absolutely making sure that I was buying at cheaper prices, because you don't always get opportunities like that in the stock market. The topic of today's video is we have earnings season, which has officially started here, and I am incredibly excited because we have two stocks that I want to discuss. The first one is going to be Johnson & Johnson, and second will be Netflix. And we're going to discuss the good, the bad, and the ugly regarding both of these stocks. So let's not waste any time. Let's get right into it. And we're going to get started here with Johnson & Johnson's income statement. And right off the bat, I'm sure you can tell by the image here, they had an incredible top line growth of about 10% for that revenue. Very strong for a company like Johnson & Johnson, who is not really known for that top line growth. So absolutely love to see that. But then as we make our way down the income statement, not everything is, as rosy as the start here, because immediately in red, I circled that their net income was down over 50% compared to this time last year, but a very important caveat, and that is because of a one-time boost that they got this time last year. And that very significant boost was a one-time gain of about $7.3 billion, which is what is making their net income for this quarter in 2026 look so terrible. Now, if you're like me, I immediately wanted to know, okay, well, if 2025 was a weird year, how about we compare to 2024 instead? How did the net income look in Q1 of 2024? And let's compare it to Q1 of 2026. Sounds reasonable, right? Well, when I did that, it actually looks like Johnson & Johnson came a little bit below their net income for this time in 2024 by about 2%. So far, we've had a mixed bag, but something that I want to highlight, which is incredibly optimistic for Johnson & Johnson, is that they raised their outlook for the remainder of 2026. Now, before this guidance, they had their midpoint for 2026 at about 6.7% growth throughout the year. After the guidance, that is now looking at about 7% growth throughout 2026. So not something incredible, it's not going to make headlines or anything, but definitely good to see a company that is increasing their guidance so early in the year. Now, what was incredibly exciting was that they made a note here on this most recent earnings that they are looking to be at double-digit growth by the end of the decade. Now, for me personally, I have Johnson & Johnson in my portfolio, not because of top-line growth, not because of double-digit growth. I really don't expect anything like that from Johnson & Johnson. What I do have high expectations for Johnson & Johnson specifically in my portfolio is that dividend growth. Now, you would expect with a path to double-digit growth, like they mentioned here in their earnings, and with top-line growth of about 10% already, that dividend should have increased by a good chunk, right? Yeah, well, they did increase the dividend, but it was very small in my opinion. 3.1% was the increase for the dividend, and to be fair, I was really expecting a dividend increase closer to 5 to 7%. At least me personally. I don't know about you. You let me know what you were expecting in the comments below. Now, that does bring Johnson & Johnson's annual dividend amount to $5.36. It used to be $5.20. And to be honest with you, it kind of seems like Johnson & Johnson is sandbagging that dividend here in 2026, because if you're telling me that you're expecting all of this growth, why isn't that reflected in the dividend growth as well? And to me, it just seems like they're hopping on the bus, because at least over the last, let's say, 2 quarters, We've had Meta that did not increase their dividend at all. They kept it the same. And we had Starbucks at the end of 2025 that increased their dividend by 1.6%. So overall, it seems like there's a slowing of dividend growth, at least over the last couple of quarters. And Johnson & Johnson seems to be hopping on that bandwagon. So definitely something that I'm going to keep in mind, especially through the rest of this earnings season, because I have plenty more dividend stocks that I'm keeping an eye on because I'm expecting more dividend increases. But I feel like I need to taper my expectations because if everybody else is going to be increasing by 2 to 3%, that's not really exciting. And I just want to highlight that Johnson & Johnson absolutely had the room to increase that dividend by more because their payout ratio, at least in my calculations here, are at 49%. So very healthy payout ratio overall. They definitely had the room to increase that dividend by more, but maybe they're just going to hold tight, keep everything a little bit conservative here for the year. I know that it's been crazy with inflation and geopolitical stuff going on and all kinds of other things that we have in the world right now. So maybe they're being a little bit more conservative this year, seeing how everything looks in 2027. And personally, I'm really hoping that the dividend growth amount in 2027 is greater than 7%. Now, initially, Johnson & Johnson was down about 3% after earnings. They were able to recover through the end of the week, ending at about negative 1.6% after everything was said and done. Now, that doesn't sound too bad, but in the grand scheme of things, like I mentioned at the beginning of the video, the stock market has been absolutely roaring for weeks now. So while it seems like 90% of all of the other stocks are increasing, and I'm not talking by small percentages either. This is an absolute V-shaped recovery here. So to be down while everybody else is going up, not a good look, at least in this moment in time for Johnson & Johnson. Now, if you were to ask me, okay, Victor, well, Johnson & Johnson is down after earnings. Are you thinking about buying more? My initial response would be an absolute no, because the stock has already been going up incredibly fast throughout the last, let's say, 6 months. So at the current price of about $230, I would say that Johnson & Johnson is at a fair valuation. And with everything just shooting up, I think that there are better opportunities in the stock market, at least here in the middle of April of 2026. But okay, that's enough of Johnson & Johnson. Now let's get to the second stock of the video, and that is going to be Netflix. And right off of the bat here, you can see that Netflix is not like Johnson & Johnson. Netflix is an absolute growth stock, and that's something important to keep in mind for later in the video. But let's have a look at their most recent income statement here, and we have revenue, which was up 16% compared to this time last year. Love to see it. Operating income came in plus 18% compared to this quarter last year. Again, absolutely love it. Now, what really threw me off was that Netflix's net income is up 83% compared to this time last year. But there is a very important caveat here that I need to mention. And the reason why the net income is so much higher compared to this time last year is because of the failed Warner Brothers acquisition. Netflix was paid a one-time fee because that deal did not go through. And because of that failed Warner Brothers acquisition, Netflix was owed a one-time fee of about $2.8 billion. Quite a pretty penny, and oh my goodness, anybody want to give me a one-time fee like that? That is insane. But I made sure to highlight that here in their most recent earnings. I'm not going to read the whole thing for you, but just to know that Paramount came in, got Warner Brothers instead, and because of that, Netflix was owed that $2.8 billion fee, which they included here on the income statement, and they recorded it under interest and other income. But okay, we just had a crash course of Netflix's income statement. Revenue looked strong, operating income looked even stronger, and of course we had that net income which absolutely ballooned, but still, everything was green for Netflix in their income statement. So how do you think that the stock performed after these earnings? Well, if you said falling off a cliff, you would be absolutely correct, because Netflix was down about 5.5% by the end of the week after these earnings. And of course, I am here to ask the question and help you answer, why exactly did Netflix fall so hard after these most recent earnings? Well, like I had mentioned a little earlier, Netflix is a growth stock, and being a growth stock comes with expectations. Let's have a look at Netflix's revenue specifically over the last couple of quarters. Back in Q4 of 2025, Netflix's revenue was up 17.6%. In this most recent earnings that we just saw, Q1 of 2026, Netflix had revenue grow by 16%. So still incredibly strong top-line growth, but as you can see, it decelerated compared to the end of 2025. So then the next question that comes to everybody's mind is, okay, well, how does the top-line growth look for Q2? Are we expecting to ramp up again? Or is the trend going to continue and, concerningly, decelerate again for 3 consecutive quarters? Well, Netflix was able to provide guidance for this upcoming quarter, and for Q2 of 2026, they expect the top line, that revenue growth, to come in at about 13.5%. Again, confirming that concern of Wall Street that revenue growth is decelerating at a staggering amount. In fact, for full year guidance in 2026, Netflix is expecting revenue growth to be about 13% for the entire year. So what are my thoughts on this guidance and the top line deceleration? Well, I'm not going to go into absolute detail when it comes to their earnings, provide projections or any of that, because I already did that back in Q3 of 2025, and I'm still going to stick to those numbers. But if you want to see all of the details, I'll provide a link here for you so you can check out that video after you're done watching this one. Now, I've been an investor in the stock market now for about 8 years, so I immediately wanted to know, okay, well, how does the PE ratio look for Netflix now that we have these updated numbers? And well, we have Netflix with a trailing PE ratio of about 31.5. When I had a look at their forward PE ratio, you can see that that is about 27. Now, if you did watch my projections and my analysis video of Netflix, in that video I mentioned that I have Netflix growing their top line through 2028 at 15%. Now again, I'm not going to go into a detailed analysis of Netflix again, but I'm just going to give you the cliff notes here. In that analysis, my bear case for Netflix was a 30 PE ratio through 2028. With those projections, I would have Netflix at about $131 in the next 3 years. That was my bear case. Now, my bull case for Netflix over the next 3 years would be at a 50 PE ratio, and under these numbers, Netflix would be well over $200 by the end of 2028. Now, right off the bat, it does come to mind that my bear case PE ratio was 30. Netflix's forward PE ratio as of now in April of 2026 is already lower than that at 27. So, something to keep in mind, but as we have seen in the stock market, things can change very quickly. I'm talking, within a couple of weeks, things can change drastically for better or for worse. So I'm not going to freak out and update my analysis just yet, but it is something I need to keep in mind, because if Netflix grows that top line by 13% instead of my projected 15%, that can definitely skew my numbers here. But I'm still going to keep Netflix here in my portfolio. It's not like I'm thinking about selling. Now, the big question now is, Netflix is trading under $100 again. I definitely feel like this was a buying opportunity for me, especially because I had mentioned when I first started buying Netflix that I wanted it to be 5 to 10% of my portfolio. And currently, I'm definitely a lot closer to that 5% than I am to that 10%. So for me, if you ask me right now in April of 2026, are you thinking about buying more Netflix? The answer would be absolutely yes. So it's something that I'm going to keep in mind over the next couple of weeks here, but I would absolutely not mind building and buying up more Netflix at these cheaper prices. But let me know what you made of Johnson & Johnson and Netflix's earnings in the comments below. Do you think that the sell-off for both of these stocks was justified? Are you buying more of either of these stocks? I would love to know what your opinions are in the comments below. And if you made it until this point in the video, like always, it is a tremendous help if you give me a like. And as always, a massive thank you to my subscribers. My goal by the end of Q2 of 2026 is to have 100 subscribers. So be sure to share this video with somebody you know. And as always, I'll catch you in the next one. Peace.